The S&P 500 is open and we see pretty much red right across the board, although the worst performing industry today is the semiconductor space, and we just saw yesterday they were also down, so a second day in a row. Now the fear and greed index, we're still sitting at the upper end of the greed point. Remember, market sentiment can move very quickly. Just a few weeks ago we were sitting in neutral. We also had some fresh off the press news with the annual inflation rate coming in today 2.6% in line with expectations, and we just saw a few weeks ago where the Fed did decrease that interest rate by around 25 basis points. Now today's episode we are focusing on 6 undervalued screaming buy opportunities for those investors who love dividends. As we can see, the first one, Pfizer, we are covering 6.41% yield, and each one lots of yield, lots of upside, and we're going to do a very quick deep dive on each one. So as we can see, Pfizer, now it is down around 15% over the last 12 months. Bear in mind, we have just done a deeper dive on this company a few days ago, so check that out if you haven't already, but we do believe it is one we should mention again, just because this is a great opportunity for those that do like the income. So down 15% over the last year. Over the last 10 years though, you would have underperformed the S&P and in fact been negative, although if you had reinvested dividends, you would be up marginally higher. Remember, this is on the basis that you had bought 10 years ago, and we can see the peak did sit December 2021 around $60. Right now, it is trading towards its 52-week low with a double buy rating seeking alpha in Wall Street with a hold from quant, although understand 3.44 isn't far off the 3.5 that would switch this to a buy. As we already mentioned, each one very nice yield. Pfizer today 6.41% and a forward P sitting just below 9. Now it isn't fair to compare it to the S&P, but just so you have context, the S&P 500 right now trading at a forward P of 25.5. In terms of Pfizer, over the next 4 quarters, what we can see, 3 of them expected to be negative, although a large increase over the upcoming quarter 4. And we also like this company because the previous 4 quarters, by quite some distance, they have outperformed analyst targets, so 100% historical accuracy. We do have to flag though, over the next full year, they are anticipating the EPS to come down marginally to 2.9. Therefore, the forward P will also go up again marginally to 9.02. Now, in terms of some of these metrics, we'll take a look at them for each one of these 6 today. 75 on the dividend safety score, severe undervaluation on the yield, severe undervaluation when we come to this model, but as we do typically mention, their dividend increase very poor last year, 2.4% below the inflationary target of 4%, but we do notice we are expecting over the next few weeks an increase from this company. Now, it was just reaffirmed at the beginning of this month, their safe score, which tells us here that a dividend cut is unlikely for Pfizer. In terms of how they performed in the last recession, so key metrics for this company during the 07-09 crash, they cut the dividend, so unfortunately they didn't increase it, they also didn't maintain it. Negative 6% recession sales, which was above the average of the S&P at negative 12, but they also outperformed, again marginally, negative 45%, the S&P itself, negative 55. Then we move on to dividend growth, already discussed there last year, but remember December is when they typically increase the dividend, so we do expect one over the next few weeks. Over the last 5 years and the last 20 years, pretty much increasing it in line with inflation, which isn't bad if you are getting a yield above 6%, and we do notice 13 years of consecutively increasing that dividend. Now when we take a look at this model, so in terms of the forward P, and we zoom in over the last 12 months, what we notice, the blue tunnel essentially being their expected fair price. Right now it sits at the lower end, in fact out of that fair value, giving us that severe undervaluation. But do understand, we don't look at any of these models in isolation, and we will come to our own conclusion when we run it through our own valuation model later on. In terms of dividend yield theory, this tells us a company is undervalued when the current yield sits above the 5-year average, 6.4, well above the 5-year 4.07. We also notice the forward P 10.4 below the 5-year rolling of 11.7, so more undervaluation signals. And a final one here, given the healthcare sector does sit significantly higher at 16.6, So it is trading right now at a discount to the healthcare sector as a whole. Now do remember, some companies deserve to be trading at a discount, so just because a company is below that median doesn't mean it is a definite buy. In terms of free cash flow, as always, we'll focus your attention on that as opposed to the earnings, which is susceptible to manipulation by management through accounting. Below 60% is what we want. The reason we target this, it ultimately gives us faith management are able to increase those dividends at a very attractive rate. Now, 193% in 2023, and again, why we focus on this and not the earnings, this tells us management paid out far more in dividends in that full year than essentially they generated in free cash flow. Red flag indicator, but positive to note, over the next 12 months, this is expected to come down to 66, and probably one of the reasons why we did see that dividend safety score being reaffirmed in the safe region. Then we move to the free cash flow, where we want to identify increasing cash flows over the longer term and consistent. Now we notice none of those here, very inconsistent, in fact pretty much flat from 2014 to 2020. Then we had COVID, where it saw very large growth. Then it dropped significantly in 2023, but with a lot of cash that they did generate from this period, they have used it in terms of acquisitions, a lot of R&D, and therefore over the next 12 months, the free cash flow is expected to increase quite rapidly to $2.53 per share. Again, the COVID effect, as we can see on their numbers, very strong in 21-22. Before then, pretty much flat, some years okay, some years pretty poor. And then we see 2023, that post-COVID drop to negative 42%. And that is reflected in their total sales, as we can see from a numerical basis. 2014, 50 billion top line. 2022 doubled to 100 billion. And then we see that large drop in 2023. Hopefully moving forwards with the amount they are putting into R&D and as well as acquiring firms, we do hope that we can see this come back up to the levels we saw in 2022. What they've also done, although we have noticed from their latest investor presentation they are putting a pause on this, they've returned excess cash to investor pockets by reducing the share count 6.42 billion to 5.7. Remember, ultimately what this does is give you a larger portion of control of the company you have invested in. Then we move on to one of our favorite metrics, the ROIC, 10% or more. Give us faith, management are able to effectively allocate their capital. We see that pretty much nearly every year, but we do want to point out 2023, not the greatest year as you can see from the numbers. Nice to see on the trailing 12 month at 7%, giving us an indication that it can be moving in the right direction moving forwards, but as always, definitely some things just to keep an eye on. Then we get to the operating margin above 12%. Now, again, inconsistent, and what we really want to identify here, not just above the minimums, but that essential efficiency with margins increasing. Not something we note. Again, like we just saw on the ROIC, it has dipped into 2023. Nice to see going back up on the trailing 12 month, and the exact same thing to be said on the free cash flow margin. In fact, very good from 2014 to 2022, drop into 23. Nice to see that rebound on the trailing 12-month basis. Then we get to the net debt to EBITDA, the earnings before interest, tax, depreciation, amortization. Below 3 is what we want to see. Now remember, this metric correlates to dividend safety, balance sheet strength, and the numbers you see below are the number of years it would take the company to pay off all of their debt net of cash on hand. Very large jump from 22 to 23. In fact, that is above the maximum we want to see. However, positive to note, it's come down on the trailing 12 month, coming lower over the next 12 months, but we would say definitely keep an eye on this for now. But overall, dividend does look to be safe and the balance sheet does look to be okay. Now let's jump into the valuation model. As always, if you do enjoy the content, value is being provided. Smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now the intrinsic value today is the average of these 4 models, and what we typically do on our deeper dives, we run through every single one of these, discussing the inputs and the outputs. Today we're going to get straight into it. $37 based on the current price. We always like to do a margin of safety where we start off with 10%. Execute on this if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that today, we'll buy up to $33.40. Then we keep going till it's near the current trading price. And what we can see in today's episode, if you are buying this company around the $26 mark, you are getting a 30% MOS, with Wall Street giving this a $33 price target over the next year. That is upside of 25% On top of that, you are getting a yield right now more than 6%. As always though, do give us your thoughts below if any of these are a buy, hold or sell. We also want to let you know we have just released our latest free weekly article. Now we drop one of these every single Monday morning to your inbox, where we talk about severely undervalued stocks that we believe deserve your attention and what's gone in the market over the last few days. So click below, sign up, and you can read straight away. You'll also be able to gain access to 40 undervalued stocks for the month of November. Lots of information for each one, the upside Wall Street themselves see over the next year, and on top of that you can grab a spreadsheet of 22 undervalued dividend stocks that Wall Street themselves believe have the most upside over the next year. So click below, sign up, and you can start reading straight away. We then move on to the Kraft Heinz company, which is trading at its 52-week low, a buy rating from Wall Street, although a hold from Seeking Alpha and Quant. The yield now sits at the 5% point, with a forward P sitting at 10.6, although over the last 12 months it is down around 4%, over the last 10 years down around 46%. In terms of moving forwards though, they are expecting growth, although minimal, over the next 4 quarters, and as we always like to see, historical forecasting accuracy looking good, with at least an in-line over the last 4, 100% track record, and a marginal increase to the EPS over the next full year, lowering that forward P to 10.36. In terms of the dividend safety, well, it sits at 60, borderline safe, so we can touch upon that. Double undervaluation signal shown, we'll go through that shortly, but they haven't increased the dividend in quite some time, definitely something just to be aware of, and it was reaffirmed, in fact, today that the score sits at 60, meaning that there is a moderate risk of a dividend cut over the full economic cycle. How do they perform in the last recession? Well, they didn't pay a dividend, so we don't have any comparative data, but they did have above average growth at negative 5.1% sales. Now, as we can see, they haven't increased that dividend since 2019, so something that we do want to flag, but they have been paying a dividend for the last 4 years without a reduction. Now, in terms of this model, we can see over the last 12 months, or in fact in the more recent period, this company has been trading at the lower end of the expected price. Right now it has started to slip out, so we do get that severe undervaluation signal. And when we look at it in terms of dividend yield, 5% above the 5-year rolling of 4.46, and on the forward PE, massive disparity, 10.5 below the 5-year of 13.3, and also significantly lower than consumer staples, so a massive discount shown. In terms of looking at the free cash flow payout for consumer staples, we do lift this to be around 70% or lower. Now, very inconsistent, although nice to see in 2023 on a trailing 12 month and over the next 12 months, it is expected to be below that maximum level, which is good to see as you are getting a fairly attractive starting yield. Now, free cash flow over the longer term, we do get inconsistency. If we just look over the last 2 years, nice to see the increase from 22 to 23, and also the increase anticipated over the next 12 months to $3.12. Then we get to the sales growth, where again we get that inconsistency shown, so do understand this isn't a type of company that is going to show double-digit returns year on year in terms of the sales or any other metrics. We want to see at least 3 to 4% at the bare minimum, just so that it does keep up in line with inflation, something we haven't seen over the longer term with Kraft Heinz. On top of that, in terms of shares outstanding, they don't really plan on essentially doing share buybacks. As we can see, for the majority of the last 10 years, these shares outstanding have stayed very stable. Then we get to the ROIC, above 12% is what we want to note. Now, we don't get that here. Instead, what we get here is consistency around the 6 to 7% year on year. And then we move to the margins. Again, consistency, no operating efficiency, but especially over the more recent period, we do see around 20% year on year. And the same to be said for the free cash flow. At least at the bare minimum, they are keeping up in line with that 7 percentage point. Then we move on to the net debt to EBITDA. Now, we did get a borderline safe score, but we want to see below 4 for consumer staples, 2.7 in 2023, significantly lower than the peak of 4.28 in 2018, and expected to go lower over the next 12 months. So based on this information, the dividend does look to be safe. Ideally, what we want to see is to kickstart those dividend increases, which would be very complementary to the high yield of 5%. In terms of our valuation, and do remember you can always grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for KHC or any others. Now our intrinsic value of 38, pretty much spot on with what Wall Street see, where they believe there's 19% upside over the next year, which is good, especially as we said, 5% yield. When we look at the MOS, well, 10% a buy at $34, at 15% a buy at $32.30, and we can see in today's episode you aren't getting the 20%, which would be around the $30 mark, but you are getting at least a 15% MOS. As we said, 19% upside, 5% yield. Give us your thoughts below. We then move on to the oil giant Shell PLC with a double buy from Seeking Alpha and Wall Street, that typical hold from Quant. We see it trading towards the lower end of the 52-week range, a yield of 4.2%, a forward PE just above 8. Over the last 12 months, we do see pretty much flat. In terms of expectations, well, bear in mind this industry is very, very cyclical, and therefore over the next 4 quarters, they are expecting decrease to the overall earnings per share, but they have beaten over the last 4 quarters by a massive discount what management had expected, so that is a great sign, but we should flag here that over the next full year, EPS is expected to lower, and in turn the forward PE is expected to rise to around 8.71. Now dividend safety, 45 borderline safe, we'll touch upon, but we do get an undervaluation on the yield, and whilst it looks like reasonable valuation, it is right at the lower end. Now they did increase the dividend in February this year, pretty much in line with inflation at that 3.9 percentage point, and we can see here it was reaffirmed that borderline score on August the 16th. Now in terms of the last recession, 07-09, didn't cut dividend, didn't increase it, they maintained it, below average growth, and also marginally outperformed the S&P, negative 42%. Now as we can see, they have had some recent cuts, but again we do want to point out this industry is very cyclical, and they've been paying a dividend for the last 3 years without a reduction, and the last 3 years with increasing consecutively. So let's talk about this valuation model where we did get that undervaluation sign, and as we can see, pretty much going up and down consistently over the 12 months, right now right at that bottom point, and more specifically when we do take a look at that dividend yield right now at 4.24%, that is above the 3.9 on the 5-year average, and the forward PE not too far off, 8.9 versus 8.6, however significantly lower as pretty much all the stocks have been today so far than the sector median at 15.1. Then we move on in terms of the metrics of the free cash flow payout, where we can see below 40% for this industry. They pretty much hit that since 2020. That is a good sign. 26% on a trailing 12 month. And then when we get to the free cash flow, even though the industry is very cyclical, we can see, in fact, more than doubled from 2014 to 2023, and a very marginal increase expected over the next 12 months. Now, this is where cyclicality really does shine through in the numbers, not in the best of ways, but as we can see, 6 of the last 10 years, including 2023, have been negative to their top line, and that is better shown when we do look at it in this numerical format. We also notice management are a little bit confused. Sometimes they like to issue shares, sometimes they like to do share buybacks, but we can see from 2018, share buybacks has been pretty much one of the priorities, coming down to 6.47, although we do have to flag here that shares outstanding was lower 10 years ago in 2014. Moving on to the ROIC, above 8% for oil producers. That is what we see over the last 3 years and on the trailing 12 month. But you do need to understand, if you do zoom out in cyclical companies, you will see periods where they have been very strong, but also periods where they have found it a little bit tough. And that is essentially shown here on the operating margin as well as the free cash flow. Although we would say over the last few years in the operating side and over the larger period on the free cash flow, Shell has done fairly well. Then we move on to the net debt to EBITDA, the final and one of the most important metrics when looking at companies that are cyclical. Below 1.5 is what we want to see for oil producers. That is what we see over the last 3 years, and we noted over the next 12 months expected to come down, although only marginally. Now, importantly, when we get to the valuation at $84, Wall Street a little bit lower at 80, nonetheless 18% upside is noticed. And then on the MOS at 10% a buy at $75, at 15 around 71, and we can see in today's episode around $67, not far at all from the current price. You are getting that 20% MOS and some nice upside. Is this one for you? Maybe you have other oil companies that you prefer, or maybe this is one you have been adding in the more recent period. Do give us your thoughts below. Then we move on to DO, which is trading at its 52-week low, although we only have one buy rating from Seeking Alpha. Wall Street today deciding to join in with Quant and give it a hold. In terms of the yield, one of the lowest we are looking at today at 3.5%, and forward PE sitting at just under 18. Now down 17% over the last 12 months, over the last 10 years, pretty much flat, but as we say, this is if you had bought it 10 years. For example, if you had bought it at the lows during COVID at around 109, you would be up, although very marginally, and we can see its all-time high around $220. That is $100 per share less than what it's currently sitting at. In terms of the expectations, well, over the next full year, June 2026, EPS is expected to increase, lowering the forward P to 16.51. We can also see around 5% anticipated growth to their top line revenue. In terms of dividend safety, well, very good to see. 99, very safe, the highest score obtainable. Massive double undervaluation signal with an increase pretty much in line with inflation this year. So let's talk about dividend safety. 99, what this means for DO is that a dividend cut is highly unlikely. And when we get to the key metrics, well, they increased the dividend, they had above average growth, but they only marginally outperformed the S&P, negative 51. We also like the fact that over the last 5 years, they have increased the dividend by a high single digit, and over the last 20 by around 7%. In fact, they are a dividend aristocrat with 25 plus years of consecutively increasing the dividend. And when we take a look at this valuation model, more specifically over the last 12 months, pretty much trading severely undervalued every single day, something to bear in mind, but as always, we will run it through the valuation model. And we see massive undervaluation, the yield 3.46 above the 5-year rolling and the forward P below the 21.8 5-year historical average. We do, however, note it isn't far off the consumer staples sector P at 17.9. In terms of free cash flow payout, a little bit of a worry, 1 or 2 years above the 100%, but we can see gradually expected to come down 80% over the next 12 months. Free cash flow also moving in the right direction, a little bit inconsistent and sometimes a little bit too slow for our liking, but we can see over the next 12 months expected to increase to 129. Then we get to sales growth, where we do in fact see 3 of the last 10 years, including 2024, although marginally at negative 1%, have had negative growth to their top line. And we can in fact see when we do zoom out, whilst they have doubled their top line from 2015 to 2024, we can see it has been in stages, and the real growth came in 21 to 22. Before that, pretty stable, and after that, fairly stable too. They have returned a little bit of excess cash, but very inconsistent, and don't consider it one of management's priorities for the time being. In terms of ROIC, we do love the consistency, not just above 12% every single year, but also increasing marginally from 14% to 16% in 2024. And then when we talk about the operating margin, marginal efficiency 28 to 30%, and the free cash flow, whilst not consistent every year, looking good and above that 7%. Net debt to EBITDA, yes, it is below 4, although very inconsistent. Some years it has been increasing, and in fact from the lows in the more recent period in 2022 at 2.44, it has been increasing 3.3. Definitely something to consider, but as we saw, the dividend safety score at 99 does give us some faith that the longevity of this dividend increase will continue. We then move on to our intrinsic value, $141, although we should point out Wall Street see this higher over the next year, 147 with 24% upside. We look at the MOS, well, 10% a buy at 127, 15% a buy at 120, which is where this is sitting now. Dividend aristocrat, yield of around 3.5%, 15% MOS, 24% upside. Buy, hold, or sell. We then move on to another company trading at its 52-week low. It is Devon Energy with a double buy rating from Seeking Alpha and Wall Street. Quant coming in with that hold again. Yield 3.8%. Forward PE sitting at around 8. Over the last 12 months, down 15%. Over the last 10 years, down around 43. We can see all-time highs around $78. Now, in terms of their earnings, again, oil and gas, cyclical industry, out of the next 4 quarters, just one with growth expected. But as we can see, we do love this historical forecasting. Actually, 100% track record, very marginal increase expected to the earnings per share, lowering the forward P, again, very marginally to 7.98. Dividend safety, 41, borderline safe, so one of the lowest we have seen today, and we have a double reasonable valuation, although we do want to point out dividend was cut not too long ago. So in terms of a 41, this was reaffirmed back end of August, and similar to the previous ones we have discussed, essentially telling us a moderate risk of a dividend cut over a full economic cycle. Now, they've maintained the dividend during the last recession below average growth, but pretty much came in near S&P at negative 54. And whilst we do have that dividend cut, on average over both the last 5 and the last 20 years, we still have seen double digit, which is always great. But again, we do need to point out that cut. Therefore, we have 0 years of consecutive increases. So what about the valuation? When we do take a look over the last 12 months specifically, we can in fact see periods where it's been severely undervalued, periods where it's been severely overvalued, and right now we see it in the middle point, therefore giving us that reasonable valuation from this model. And in terms of dividend yield theory, you could argue in fact overvaluation or reasonable valuation comparing the yield to the 5-year, although we do note the forward P sitting around the same as the 5-year, 8.8 versus 8.4, but much lower than Energy's 15.1. So what about the free cash flow payout? We've already said we want below 40% for this essential metric, and we note 71, fairly high in 2023. Good to see though, it is expected to come down to 31% over the next 12 months. So Devon Energy, we do want to see more high double-digit increases to the dividend. Then we get to the free cash flow per share. No surprises, essentially that cyclicality shining through. But from the lows in 2014, 2016, or the negatives we should say, it has looked fairly strong moving forwards, and a marginal increase expected from 2023 to the next 12 months. We then get to the sales growth, where in fact we see 6 years of negative growth, including 2023. And again, from a numerical standpoint, that is very obvious. Shares outstanding, now they have been diluting your position over the longer term, 407 to 631. Again, lots to consider with this company. Yes, yield, very good, very attractive, but do understand there are some indicators that we would consider to be a red flag, but some investors will still like this company and definitely something they want to consider. In terms of ROIC, looking very strong and attractive, especially over the last 3 years. And when we get to the operating margin and the same format in terms of the more recent period, well above that minimum 12%, and the same again to be reflected on the free cash flow. As always though, do always take a look at the wider view, which is why we always incorporate a 10-year analysis. In terms of net debt to EBITDA though, below 1.5 is what we want to see. That is what we get for a large substantial amount of time, especially over the last 3 months, trailing 12 month and the next 12 months. Remember though, we did see that borderline safe score, but based on this information right now, the dividend does look to be safe. Intrinsic value, $55, Wall Street at 52, so marginally lower, and they see significant upside at 37%. And when we do run it through the MOS in today's episode, what we can in fact see is that this company is trading at around 30% margin of safety, up to $39. Wall Street upside of 37%. Some people though will be put off by the dividend cut, and as always, give us your thoughts below. We then move on to the real estate investment trust Stag Industrial, and this one actually, unlike the others, pays on a monthly basis. The others we ran through pay on a quarterly basis, and as we can see, a double buy signal from Seeking Alpha and Wall Street, hold from Quant, trading in the mid to lower end of the 52-week range, a forward yield just above 4%, a P to FFO, price to funds from operation, at just above 15, and over the last 12 months, up around 9.5%, over the last 10 years, up around 59%, and we can in fact see all-time highs in sitting around that essential $48 at the back end of 2021. Now, in terms of looking at expectations, well, they do expect the funds from operation to continue to increase over the next year, next 4 quarters as well, and we can see last 4 at least in line, 100% track record, with FFO anticipated to increase, and in turn forward P to FFO expected to come down. Now, dividend safety, we do get a 60 borderline safe score with double reasonable valuation, and we have to be honest, we are disappointed with this company in terms of their dividend growth on a year-on-year basis. In terms of dividend safety itself, well, reaffirmed today at that borderline safe. As we've already ran through it twice, we don't need to go through it again today. And the key metrics, they had pretty much average growth during the 07-09 recession. Now, do bear in mind, they do pay essentially every single month. They don't have the most attractive increases to their dividend, and what we can in fact see, they've been increasing those dividends for the last 12 years on a consecutive basis. So let's look at the valuation, and when we zoom in over the last year, can identify it is sitting at the midpoint of the intrinsic value, and in terms of the yield, it isn't too far off the 5-year. You could argue reasonable valuation. Forward P, again, the same to be said, so another reasonable signal. And when we do get to the P to FFO, it is marginally higher than real estate as a whole, so trading at a fairly small premium. Now, as we have seen on the previous companies, we focus on free cash flow. For REITs, a little bit more volatile, so we draw your attention to the AFFO. Below 75% for industrial REITs, something we have seen in 2023 and something expected to go lower over the next 12 months. So Stag Industrial, please, what we would like to see here is higher increases to that dividend. AFFO, we want to see consistent increases over the longer term. Now, not consistent, but not massively inconsistent, and expected to increase about 5.5% over the next 12 months. So that is positive to note. And in terms of the AFFO per share growth year on year, it does look fairly attractive, although we do have to point out COVID, they had that 10% drop. And in terms of sales growth, 5 to 10%, it has started to slow down, so something to consider in your overall investment thesis. Now, total sales numerically, though, it has nonetheless, when we zoom out, gone up at a very, very rapid rate. And we would have to tell you here, shares outstanding, something we typically see with REITs, they dilute your position as they pay out the majority of that internally generated cash flow as dividends. Some REITs will, however, dilute your position at a very rapid rate. ROIC for companies 10% or more, REITs 3 to 5%. Nice to see, been increasing over long term. Right now 4% and on a trailing 12 month, therefore indicating to us sitting at the midpoint of what we want to see. Operating margin, one of the first, or if not the first today, where we get clear indicators of operating efficiency. 14% to the margin, 35% on a trailing 12-month basis. And very important to understand why we get the borderline safe score today. For REITs, we want to see this below 5. Stag Realty, now look, it's been straddling around that year on year. 4.97 in 23. Nice to see, anticipated over the next 12 months to go down to 4.89. So just something to be wary of. With REITs, we do find this typically high, but as always, lots of information. Do consider it in your investment thesis. Now, intrinsic value, $41.50. We can see Wall Street marginally higher. They see upside of 15% for this monthly paying dividend REIT. And in terms of our margin of safety today, at 10%, a buy at 37.31, which is around where the company sits. Some people will be happy with that because it pays out monthly. Some people will want higher, 15%, a buy at $35. And for those that want to see 20%, around 33. So at 10% with 15% upside, do give us your thoughts below. If you've enjoyed today's episode, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Don't forget to sign up to the free weekly newsletter below where we are sending out an article every single Monday morning. And finally, do join us in the Patreon where we do talk about our weekly buys and sells. As always, have a great day and we'll see you all on the next one.